Good morning, class, and welcome to Synapse Global Institute. I am delighted to have you with us today as we begin our journey into economics for the CPA program. I am your instructor for economics, and throughout this course I will be guiding you step by step, ensuring that concepts are clear, relevant to professional practice, and aligned with examination expectations. Synapse operates on a flexible learning model, so I encourage you from the very beginning to actively participate by using the chat section at any time to ask questions, seek clarification, or share examples from your own experience. Economics is best understood when discussed, not memorized. Today we begin with Section 1.1, Introduction to Economics, and in this first 20-minute segment we focus exclusively on the definition of economics. This foundation is critical because every other concept you will study in microeconomics and macroeconomics flows from how economics itself is defined and understood. According to your study material, economics is presented as a social science concerned with how individuals, organizations, and governments manage and utilize scarce resources in order to satisfy unlimited human wants. The key words here are social science, scarce resources, unlimited wants, and choice, and we will unpack each of these carefully. Economics is referred to as a social science because it studies human behavior in relation to production, consumption, and distribution of goods and services. Unlike natural sciences such as physics or chemistry, economics does not study inanimate objects, but people, institutions, and societies. This means economic outcomes are influenced not only by numbers but also by attitudes, incentives, culture, and policy decisions. For CPA students, this is especially important because economic conditions directly affect business performance, financial reporting, taxation, and strategic decision-making. At the core of economics is the problem of scarcity. Scarcity exists because resources are limited while human wants are unlimited. Resources include land, labor, capital, and entrepreneurial ability, and these are never sufficient to produce everything that everyone desires. Even wealthy countries face scarcity. The difference is only in degree, not in existence. For example, a government may have limited budgetary resources and must choose between spending more on healthcare, education, infrastructure, or debt repayment. The fact that not all objectives can be achieved simultaneously is what makes economics necessary. Because of scarcity, choice becomes unavoidable. Every individual, business, and government must make decisions about how best to allocate limited resources among competing uses. When you decide to spend your income on professional tuition, you may have to reduce spending on leisure or savings. When a business allocates funds to expand production, it may delay investment in new technology. When a government increases spending on public wages, it may have fewer resources available for development projects. Economics studies how these choices are made and how rational decision-makers attempt to maximize satisfaction or utility given their constraints. Closely linked to choice is the concept of opportunity cost, which is embedded in the definition of economics as the science of scarcity and choice. Opportunity cost refers to the value of the next best alternative that is foregone when a choice is made. This concept is central to economic reasoning and is frequently examined in CPA assessments. For instance, if a company uses retained earnings to purchase new machinery instead of paying dividends, the opportunity cost is the satisfaction shareholders would have gained from those dividends. Economics trains us to think not only about what we choose, but also about what we give up. Economics also addresses three fundamental questions that arise from scarcity and choice: what to produce, how to produce, and for whom to produce. What to produce concerns the selection of goods and services and their quantities. How to produce focuses on the methods and combinations of resources used in production, such as labor-intensive versus capital-intensive techniques. For whom to produce deals with distribution, that is, how output is shared among members of society. These questions apply at all levels, from a small enterprise deciding its product mix to a national government setting development priorities. The definition of economics further recognizes that decision-making occurs at different levels. At the individual level, economics explains choices related to consumption, saving, and investment. At the business level, it guides decisions on production, pricing, and cost control. At the government level, it informs policies on taxation, public expenditure, regulation, and economic growth. For CPA professionals, understanding these levels is essential because financial information is both influenced by and used to influence economic decisions. Finally, economics integrates local decisions into a global context. A production decision made by a local firm or farmer can affect national output, employment, trade balances, and even international prices. This interconnectedness explains why economics is a foundational subject for professionals operating in an increasingly globalized business environment. As future CPAs, you will need to interpret financial data with an awareness of the broader economic environment in which organizations operate. At this point, we have completed our first section on the definition of economics. I encourage you to pause the session now, take a short 5-minute break, reflect on the key ideas of scarcity, choice, and opportunity cost, and then return refreshed for the next section where we will build on this foundation. Remember, you can pause, rewind, and revisit this material at any time under the Synapse flexible learning model. Please continue to use the chat section to ask any questions before we proceed to the next topic. We now proceed to the next section of our lecture, which focuses on basic economic concepts. As always, feel free to use the chat section at any point to ask questions or request clarification. Economics becomes much clearer when you engage actively with the ideas rather than passively listening. This section builds directly on the definition of economics by explaining the key concepts that economists use to analyze how scarce resources are allocated to satisfy unlimited human wants. According to your study material, these core concepts include economic resources, human wants, scarcity and choice, opportunity cost, and the production possibility curve or frontier. Mastery of these ideas is essential for CPA students because they recur throughout microeconomics, macroeconomics, public finance, and business decision-making. Begin with economic resources, also known as factors of production. These are the inputs used in the production of goods and services. Economics traditionally classifies them into 4 categories: land, labor, capital, and entrepreneurship. Land refers to all natural resources provided by nature, such as agricultural land, minerals, forests, water bodies, and fisheries. In the Kenyan context, examples include fertile agricultural land in the Rift Valley, tea plantations in the highlands, and mineral resources. Labor represents human effort, both physical and mental, applied in production. This includes skilled professionals such as accountants and engineers, as well as unskilled and semi-skilled workers. Capital refers to man-made goods used to produce other goods, such as machinery, buildings, equipment, and tools. It is important not to confuse capital in economics with money. Money is a financial asset, while capital refers to productive assets. Entrepreneurship is the factor that brings all other resources together. Entrepreneurs identify opportunities, take risks, organize production, and make strategic decisions. Without entrepreneurship, land, labor, and capital would remain uncoordinated and underutilized. Next, we consider human wants. Human wants are the desires for goods and services that individuals believe will give them satisfaction or utility. Wants differ from needs. Needs are basic requirements for survival, such as food, shelter, and clothing, while wants go beyond survival and include items such as smartphones, private cars, entertainment, and luxury housing. A key economic insight is that human wants are unlimited. As one want is satisfied, another emerges. This explains why scarcity persists even as economies grow and standards of living improve. Scarcity and choice are inseparable concepts in economics. Scarcity exists because the available economic resources are insufficient to satisfy all human wants fully. As a result, individuals, firms, and governments must make choices. choosing one option necessarily means giving up another. For example, a business with limited capital may have to choose between expanding production capacity or investing in staff training. A government with limited tax revenue may have to choose between improving healthcare facilities and upgrading transport infrastructure. Economics studies how such choices are made and how resources can be allocated efficiently. This naturally leads us to opportunity cost, which is one of the most important concepts in economics and a frequent examination area. Opportunity cost is defined as the value of the next best alternative foregone when a choice is made. It is not simply about money, it includes time, benefits, and satisfaction given up. For instance, if you choose to attend a CPA revision class instead of working overtime, the opportunity cost may be the income you would have earned during that time. For a firm, using factory space to produce one product means sacrificing the opportunity to produce another. Opportunity cost reminds us that every economic decision has a real cost, even when no direct payment is involved. To illustrate scarcity, choice, and opportunity cost more clearly, economists use the production possibility curve or frontier, PPC/PPF. The PPC is a graphical representation showing the maximum combinations of two goods that an economy can produce using its available resources and existing technology. Assuming full and efficient use of those resources in your material, the PPC is illustrated using an economy that produces food and clothing. Each point on the curve represents a possible combination of the two goods when resources are fully utilized. The PPC is based on several simplifying assumptions, including that only two goods are produced, resources are fixed in quantity and quality, technology is constant, and all resources are fully employed. These assumptions allow economists to focus on the essential problem of scarcity without unnecessary complexity. The typical PPC is concave to the origin, reflecting the law of increasing opportunity cost. This means that as more of one good is produced, increasingly larger amounts of the other good must be sacrificed because resources are not equally efficient in producing all goods. Points on the PPC represent productive efficiency, where the economy is using its resources fully. Points inside the curve indicate inefficiency, such as unemployment or misallocation of resources. Points outside the curve are unattainable with current resources and technology. Economic growth is shown by an outward shift of the PPC, which may result from increases in labor, capital accumulation, technological progress, or improvements in human capital. This concept is particularly relevant for understanding national development and long-term business planning. In summary, basic economic concepts provide the analytical tools needed to understand how scarce resources are allocated, how choices are made, and how trade-offs arise in both personal and professional contexts. As CPA students, these ideas will help you interpret business decisions, evaluate policy choices, and understand the economic environment in which financial information is produced and used. At this point, we pause again. Please take advantage of the Synapse flexible learning model by pausing the session and taking a short 5-minute break. When you return, we will proceed to the next section on the scope of economics, focusing on microeconomics and macroeconomics. Remember to use the chat section to post any questions or reflections before we move on. Let us continue with the next section of our lecture. In this segment, we focus on the scope of economics, specifically the distinction between microeconomics and macroeconomics. This section is very important for CPA students because many examination questions, as well as real-world business and policy discussions, require you to clearly identify whether an issue is microeconomic or macroeconomic in nature. As always, please keep using the chat section to ask questions or share examples as we move along. Economics as a discipline is broadly divided into two major branches, microeconomics and macroeconomics. Each branch examines economic behavior from a different perspective, yet both are closely interconnected and together provide a complete understanding of how an economy functions. Understanding this division helps you analyze economic problems at the appropriate level and apply the correct tools and reasoning. Begin with microeconomics, which is concerned with the behavior of individual economic Units. These units include consumers, households, firms, and individual markets. Microeconomics studies how these decision makers allocate scarce resources and how their interactions determine prices, output, and the distribution of resources. For example, microeconomics explains how a consumer decides how much of their income to spend on food versus transport, or how a firm determines the price of its product based on costs and demand conditions. A key area of microeconomics is consumer behavior. This involves analyzing how consumers make choices given their income constraints, preferences, and the prices of goods and services. For CPA students, this is relevant when analyzing demand patterns, pricing strategies, and revenue projections. Another important area is production and cost analysis, which examines how firms choose the most efficient combination of resources to minimize costs and maximize profits. This directly links to managerial decision-making, budgeting, and cost control. Microeconomics also studies market structures, such as perfect competition, monopoly, monopolistic competition, and oligopoly. These structures influence how prices are set, how much output is produced, and how firms behave. For instance, a firm operating in a highly competitive market has limited control over prices, while a monopolist may have significant pricing power. In addition, microeconomics examines factor markets, where resources such as labor, land, and capital are bought and sold. Wages, rent, interest, and profits are all determined in these markets. We now turn to macroeconomics, which looks at the economy as a whole rather than at individual units. Macroeconomics focuses on aggregate variables such as national income, total output, employment levels, inflation, and economic growth. Instead of analyzing the behavior of one firm or consumer, macroeconomics examines the combined outcomes of millions of individual decisions. For example, while microeconomics studies how a single household decides how much to save, macroeconomics examines total savings and investment in the economy. Key areas of macroeconomics include national income accounting, which measures the overall performance of an economy using indicators such as gross domestic product, GDP. Macroeconomics also studies economic growth, seeking to understand how economies expand their productive capacity over time and improve living standards. Issues of inflation and unemployment are central to macroeconomic analysis because they affect purchasing power, business profitability, and social stability. In addition, macroeconomics examines fiscal policy, which involves government decisions on taxation and spending, and monetary policy, which involves central bank actions related to interest rates and money supply. Although microeconomics and macroeconomics focus on different levels of analysis, they are deeply interconnected. Decisions made at the microeconomic level often have macroeconomic consequences. For example, if many households decide to reduce spending and increase savings, aggregate demand in the economy may fall, leading to slower economic growth or higher unemployment. Conversely, macroeconomic conditions such as high inflation or rising interest rates influence microeconomic decisions by firms and consumers. Businesses may delay investment during periods of economic uncertainty, and consumers may cut back on spending when prices rise rapidly. For CPA students, this interrelationship is particularly important. Financial statements, budgets, and forecasts are prepared at the firm level, which is microeconomic, but they are influenced by macroeconomic factors such as interest rates, exchange rates, and economic growth. A sound understanding of both branches enables you to interpret financial information within the correct economic context and make more informed professional judgments. We have now completed this section on the scope of economics, covering microeconomics and macroeconomics and their interdependence. I encourage you once again to pause the session and take a short 5-minute break under the Synapse flexible learning model. When you return, we will move on to the methodology of economics, where we will discuss positive and normative economics and the use of scientific methods in economic analysis. Please remember to post any questions or comments in the chat section before we proceed. let us continue with the next segment of our lecture. In this section, we examine the methodology of economics, which explains how economists think, analyze problems, and arrive at conclusions. This topic is particularly important for CPA students because it develops analytical discipline and helps you distinguish between factual economic analysis and value-based policy opinions. As always, please use the chat section freely to ask questions or seek clarification as we go along. The methodology of economics refers to the approaches and techniques economists use to study economic issues and propose solutions. Economics does not rely on guesswork or opinion alone. Instead, it uses structured reasoning, models, and evidence to explain economic behavior and predict outcomes. Your study material emphasizes that economic methodology combines theoretical analysis with empirical observation, guided by the distinction between positive and normative economics and by the use of scientific methods within a social science framework. A central distinction in economic methodology is between positive economics and normative economics. Positive economics is concerned with describing and explaining economic phenomena as they are. It focuses on objective, testable statements that can be supported or refuted using data. Positive economics asks questions such as what is happening, or what will happen if a particular policy is implemented. For example, the statement an increase in interest rates reduces borrowing by businesses is a positive economic statement because it can be tested using data and empirical analysis. In professional practice, CPAs often rely on positive economic analysis when forecasting, budgeting, and evaluating the financial impact of economic changes. In contrast, normative economics deals with value judgments and opinions about what ought to be. It is concerned with policy recommendations and ethical considerations rather than objective facts. Normative economics addresses questions such as what should the government do, or what is the best policy to reduce income inequality. For example, the statement the government should reduce taxes to stimulate economic growth is a normative statement because it reflects a value judgment and cannot be proven true or false purely by data. It is important for CPA students to clearly distinguish normative opinions from positive analysis, especially when advising management or interpreting economic policy debates. Economics also applies the scientific method in its analysis, although in a way that reflects the complexity of human behavior. Economists begin by observing real-world economic phenomena, such as changes in prices, employment, or output. They then develop theories or models that simplify reality in order to explain these observations. A model is a simplified representation of an economic situation that highlights key relationships while ignoring less relevant details. For instance, a demand and supply model explains price determination by focusing on buyers and sellers while abstracting from individual personalities and motivations. From these models, economists derive hypotheses, which are statements that can be tested against real-world data. Using statistical and econometric techniques, economists analyze data to determine whether the evidence supports or contradicts the hypothesis. If the evidence consistently contradicts a theory, the theory may be revised or rejected. This process of model building, hypothesis testing, and refinement reflects the scientific approach used in economics. Despite using scientific methods, economics remains fundamentally a social science. This is because economic outcomes are shaped by human behavior, which is influenced by social, cultural, political, and psychological factors. Unlike laboratory sciences, economists cannot easily conduct controlled experiments on entire economies. As a result, economic predictions are often subject to uncertainty and must be interpreted with caution. Cultural norms may influence consumption patterns, political decisions may affect economic policies, and psychological biases may lead individuals to behave in ways that are not fully rational. Understanding economics as both a science and a social science helps explain why economists may disagree on policy recommendations even when they analyze the same data. Different value judgments, assumptions, and interpretations can lead to different conclusions. For CPA students, this insight is valuable because it encourages critical thinking and careful evaluation of economic arguments rather than blind acceptance of conclusions. We have now completed the section on the methodology of economics, including the distinction between positive and normative economics, the use of scientific methods, and the nature of economics as a social science. I encourage you to pause once again, take a short 5-minute break using the Synapse flexible learning model, and reflect on how economic analysis differs from opinion or advocacy. When you return, we will proceed to the next section on economic systems, where we will examine planned, free market, and mixed economies. Please remember to post any questions in the chat section before we move on. Let us proceed with the next section of our lecture, which focuses on economic systems. This section is particularly important because it explains how different societies organize their economies and make decisions about production, distribution, and consumption. As CPA students, understanding economic systems will help you interpret government policies, regulatory environments, and business practices within different countries. Please continue to use the chat section actively if anything is unclear or if you would like to relate these ideas to real-world examples. An economic system refers to the framework through which a society decides what goods and services to produce, how to produce them, and for whom they are produced. It determines how resources such as land, labor, capital, and entrepreneurship are allocated and how economic decisions are coordinated. Your study material identifies 3 main types of economic systems: the planned economy, the free market economy, and the mixed economy. Each system reflects a different balance between government control and market forces. We begin with the planned economy, also known as a command economy. In this system, the government exercises centralized control over economic activity. Major decisions regarding production, investment, pricing, and distribution are made by government authorities rather than by individual consumers or firms. The government sets production targets, allocates resources, and fixes prices according to national priorities. The main objective is often to achieve social welfare goals such as employment stability, income equality, and provision of basic necessities. Planned economies have certain advantages. Because the government controls resources, it can mobilize them quickly for large-scale projects such as infrastructure development, healthcare, or national defense. Prices and employment levels tend to be more stable, reducing uncertainty for citizens. In addition, planned economies often emphasize equitable distribution of income and access to basic goods and services. However, there are also significant disadvantages. The absence of competition and profit. Incentives often leads to inefficiency, low productivity, and poor quality goods. Consumer preferences may be ignored, resulting in shortages or surpluses. Centralized decision-making can also create bureaucratic delays and reduce innovation. Historically, economies such as the former Soviet Union and North Korea are cited as examples of planned economies. Next, we consider the free market economy. In this system, economic decisions are made through the interaction of individuals and firms in markets, with minimal government intervention. Prices are determined by the forces of demand and supply, and resources are allocated based on consumer preferences and profitability. Firms decide what to produce and how much to produce, while consumers influence production through their purchasing decisions. The free market economy offers several advantages. Resources tend to be allocated efficiently because firms respond to price signals and consumer demand. Competition encourages innovation, cost reduction, and improved product quality. Consumers benefit from a wide variety of goods and services and greater freedom of choice. However, free market economies also face challenges. Income and wealth inequalities can be significant, as market outcomes depend on initial endowments and opportunities. Market failures may occur, such as environmental pollution, underprovision of public goods, or exploitation of consumers. Without regulation, firms may prioritize short-term profits over long-term sustainability. Countries such as the United States and Singapore are often described as having predominantly free market economies, although even these economies involve some government regulation. Most modern economies operate under a mixed economy, which combines elements of both planned and free market systems. In a mixed economy, private enterprise plays a major role in production and distribution, but the government intervenes to regulate markets, correct market failures, and provide public goods and social services. Economic decisions are influenced by both market forces and government policies. The mixed economy aims to capture the strengths of both systems. It allows markets to promote efficiency, innovation, and consumer choice, while government intervention helps address inequality, protect consumers, regulate monopolies, and provide essential services such as education, healthcare, and infrastructure. This flexibility enables governments to respond to economic crises and changing social needs. However, mixed economies also face challenges. Excessive government intervention can discourage entrepreneurship and reduce economic freedom, while unclear boundaries between market and state roles can create uncertainty for businesses. Striking the right balance between market forces and government control is often a source of political debate. Most countries today, including Kenya, Canada, Germany, and France, operate mixed economies with varying degrees of government involvement. Understanding economic systems helps you appreciate why economic outcomes and business environments differ across countries. For CPA professionals, this knowledge is critical. When analyzing financial information, advising organizations, or working in multinational contexts where regulatory frameworks and market conditions vary widely. We have now completed the section on economic systems. I encourage you to pause the session at this point, take a short 5-minute break under the Synapse flexible learning model, and reflect on how different economic systems influence business behavior and financial decision-making. When you return, we will move to the final section of this chapter, which examines consumer sovereignty and its limitations. As always, please use the chat section to ask any questions before we proceed. We now proceed to the final section of this lecture, which focuses on consumer sovereignty and its limitations. This topic is especially relevant for understanding how markets function in practice, as opposed to how they function in theory. As CPA students, this section will help you evaluate market outcomes critically and understand why government regulation and corporate strategy play such an important role in modern economies. As always, please continue using the chat section to ask questions or raise examples from your own observations. Consumer sovereignty refers to the idea that consumers ultimately determine what goods and services are produced in an economy through their purchasing decisions. The central notion is that producers respond to consumer demand. Goods that consumers are willing and able to buy are produced, while those that consumers reject are withdrawn from the market. This is why the consumer is often described as the king in a market economy. In theory, firms that satisfy consumer preferences earn profits and survive, while those that fail to do so incur losses and exit the market. In a free market setting, consumer sovereignty operates through the price mechanism. When demand for a product increases, prices tend to rise, signaling producers to increase supply. When demand falls, prices decline, encouraging firms to reduce production or redirect resources elsewhere. This process promotes efficiency by ensuring that scarce resources are allocated to the production of goods and services that consumers value most. From a professional perspective, this explains why businesses invest heavily in market research, customer feedback, and demand analysis. Consumer sovereignty offers several advantages. It encourages efficient use of resources, as firms focus on producing what consumers actually want rather than what producers or governments think they should want. It promotes innovation, because businesses must continuously improve products and services to attract and retain customers. It also enhances consumer welfare, as production is aligned with preferences, leading to greater satisfaction and variety. At a broader level, strong consumer demand can stimulate business expansion, job creation, and economic growth. However, in reality, consumer sovereignty is not absolute and is subject to significant limitations. One major limitation arises from producer power and market structures. In markets dominated by monopolies or oligopolies, firms may have substantial control over prices, output, and product availability. When competition is weak, producers can restrict supply, charge higher prices, or limit consumer choice, reducing the influence consumers have over production decisions. This is particularly relevant in industries such as utilities or telecommunications, where high entry barriers exist. Another important limitation is advertising and consumer manipulation. Firms do not simply respond passively to consumer preferences. They actively shape them through advertising, branding, and marketing strategies. Consumers may be persuaded to buy products not because they genuinely need or value them, but because of emotional appeals, social pressure, or misleading information. In such cases, production reflects the success of marketing campaigns rather than true consumer welfare. Government regulation and policy also limit consumer sovereignty. Governments may restrict or prohibit the production and consumption of certain goods for health, safety, environmental, or moral reasons. Taxes, subsidies, price controls, and bans influence what is produced and consumed, regardless of consumer demand. For example, environmental regulations may restrict certain manufacturing activities even if consumers demand cheaper alternatives. While these interventions limit consumer choice, they are often justified on the grounds of protecting society as a whole. A further limitation is income and wealth inequality. Consumer sovereignty assumes that each consumer's preferences carry equal weight, but in reality, purchasing power varies significantly. Wealthier consumers have a greater influence on what is produced because their demand is backed by higher income. As a result, markets may cater more to luxury goods and services while neglecting the needs of low-income groups, even if those needs are socially important. Finally, imperfect information and social influences weaken consumer sovereignty. Consumers often lack full information about product quality, long-term costs, or potential risks, while producers may possess superior knowledge. This information asymmetry can lead to poor consumer choices. In addition, cultural norms, traditions, and peer pressure influence consumption patterns, meaning choices are not always purely individual or rational. In summary, consumer sovereignty is a useful concept for understanding how markets are supposed to work, but it must be applied with caution. In modern economies, producer power, advertising, government intervention, income inequality, and information gaps all constrain the extent to which consumers truly control production. For CPA professionals, recognizing these limitations is essential when analyzing markets, evaluating business strategies, or interpreting economic policies. This brings us to the end of Section 1.1, Introduction to Economics. At this stage, I encourage you to pause the session and take a short 5-minute break in line with the Synapse flexible learning model. Use this time to reflect on the key concepts we have covered, particularly scarcity, choice, opportunity cost, and the role of economics in decision-making. Remember, you can pause, rewind, and revisit any part of this section at your own pace. When you return, we will move into the next section, where we shall examine sample CPA examiner-style questions drawn from this chapter. In that section, we will focus on how these concepts are tested in the examination, how to structure high-scoring answers, and how to apply economic theory clearly and professionally. As always, please continue to use the chat section to ask questions or seek clarification as we work through the sample questions together. Below are 5 popular CPA examiner style questions drawn from Introduction to Economics, Section 1.1, together with comprehensive, examiner-focused solutions presented in lecture notes style. The explanations are written to show how a CPA student is expected to think, structure, and discuss answers in the examination, moving beyond definitions into application and interpretation, exactly as examiners reward. Question 1. Define economics and explain why it is referred to as the science of scarcity and choice. In the CPA examination, this question tests both conceptual understanding and economic reasoning. Economics is defined as a social science that studies how individuals, firms, and governments allocate scarce resources among competing uses in order to satisfy unlimited human wants. The emphasis is not merely on wealth or money, but on decision-making under conditions of limitation. Economics is described as the science of scarcity because resources such as land, labor, capital, and entrepreneurship are limited in supply, while human wants are unlimited. No society, regardless of its level of development, has enough resources to satisfy all wants fully. Scarcity therefore exists universally and forces economic agents to confront constraints in their decision-making. Because of scarcity, choice becomes unavoidable. Individuals must choose how to spend their limited income, firms must decide what goods to produce and which production methods to use, and governments must prioritize among competing public needs such as healthcare, education, and infrastructure. Every choice involves a trade-off, as selecting one option means foregoing another. Economics studies how these choices are made and how rational decision-makers attempt to achieve maximum satisfaction or benefit within their constraints. It is this systematic analysis of scarcity-induced choices that justifies economics being called the science of scarcity and choice. Question 2. Explain the concept of opportunity cost and illustrate its relevance in business and government decision-making. Opportunity cost is a core principle in economics and a frequent CPA examination topic. It refers to the value of the next best alternative that is foregone when a choice is made. It highlights that the true cost of any decision is not just the monetary expense incurred, but the benefits sacrificed by not choosing the best alternative option. In business decision-making, opportunity cost is critical when allocating limited resources. For example, if a firm uses retained earnings to expand its production plant, the opportunity cost may be the dividends that could have been paid to shareholders or the return that could have been earned from an alternative investment. Ignoring opportunity cost may lead to decisions that appear profitable on the surface but are inefficient when compared with better alternatives. In government decision-making, opportunity cost is even more pronounced due to budget constraints. When a government allocates funds to defense spending, the opportunity cost may be reduced investment in education or healthcare. Since public resources are limited, every policy choice involves sacrificing potential benefits elsewhere. Understanding opportunity cost therefore ensures better prioritization and more efficient resource allocation, which is essential for sound economic and financial governance. Question 3. Using a production possibility curve, PPC, explain the concepts of scarcity, choice, opportunity cost, and economic growth. The production possibility curve is a graphical tool used to illustrate fundamental economic concepts. It shows the maximum combinations of two goods that an economy can produce with given resources and technology, assuming full and efficient utilization of resources. Scarcity is demonstrated by the existence of the PPC itself, as it shows that resources are limited and cannot produce unlimited quantities of both goods simultaneously. Choice is illustrated by the need to select a particular point on the curve, representing a specific combination of goods. An economy must decide how much of one good to produce relative to another. Opportunity cost is shown by movement along the PPC. As production shifts from one good to another, the economy sacrifices some quantity of the alternative good. The slope of the PPC reflects this trade-off, and its concave shape illustrates increasing opportunity cost, arising because resources are not equally efficient in producing all goods. Economic growth is represented by an outward shift of the PPC. Such a shift indicates an increase in productive capacity resulting from factors such as technological advancement, capital accumulation, improved labor skills, or an increase in available resources. The PPC therefore provides a comprehensive framework for analyzing efficiency, trade-offs, and long-term economic progress. Question 4. Differentiate between microeconomics and macroeconomics and explain why both are important in economic analysis. Microeconomics and Macroeconomics represent two complementary branches of economics, distinguished by the level of analysis. Microeconomics focuses on individual economic units such as households, firms, and specific markets. It examines how consumers make choices, how firms determine output and pricing, and how resources are allocated within individual markets. Macroeconomics, on the other hand, studies the economy as a whole. It focuses on aggregate variables such as national income, total output, inflation, unemployment, and economic growth. Rather than analyzing individual decisions, it examines the combined outcomes of millions of microeconomic actions. Both branches are important because they are interdependent. Microeconomic decisions influence macroeconomic outcomes. For example, household saving affects national investment levels. Similarly, macroeconomic conditions such as inflation or interest rates influence microeconomic behavior by firms and consumers. For CPA students, understanding both perspectives is essential, as financial decisions at the firm level are shaped by broader economic conditions. Question 5. Explain the concept of consumer sovereignty and critically discuss its limitations in modern economies. Consumer sovereignty refers to the idea that consumers determine what goods and services are produced in an economy through their purchasing decisions. In theory, producers respond to consumer demand, producing goods that consumers are willing and able to buy and discontinuing those that lack demand. While consumer sovereignty promotes efficiency, innovation, and responsiveness to consumer needs, it is significantly limited in practice. Market structures such as monopolies and oligopolies reduce consumer influence by restricting competition and choice. Advertising and branding can manipulate consumer preferences, leading individuals to buy goods based on persuasion rather than genuine need. Government intervention also limits consumer sovereignty through regulations, taxes, subsidies, and bans aimed at protecting public welfare. Additionally, income inequality means that wealthier consumers exert greater influence over production decisions than low-income groups. Information asymmetry further weakens consumer sovereignty, as producers often possess more information than consumers. As a result, consumer sovereignty in modern economies is partial, rather than absolute.